You are listening to Mining Stock Education.
So, because it's the overshoot factor. Money doesn't flow when you hit the incentive price. Money flows when you get to twice the incentive price. So basically, that's me saying that there's $12 copper in this market somewhere. And by that time, look out, there will be lots of capital projects getting sanctioned.
Welcome to Mining Stock Education. My name is Brian Lenny. Today with me, I have Brian Dalton, CEO of Altius Minerals. In our conversation today, you will hear Brian's views on the current state of the mining royalty sector, where the competitive edge is between royalty companies, contrarian opportunities in the sector, and Altius' acquisition of Lithium Royalty Corp. Brian, it's great to have you back on the show. Over the last year or so, we've seen more capital deployed in royalty transactions than we've seen probably in the prior years combined. The sale of the Silicon royalties, Altius and Origin being at the center of that, Sandstorm, Trident, Horizon, to name a few others. The royalty space seems very healthy. What's your take on what's driving these deals and sort of the health of the market?
Yeah, I think the whole consolidation theme is very much alive and well. And, lots of people, including ourselves, would have talked about the need for that for the past number of years. On the other hand, there seems to be just as many new entrants popping in every time another couple, marry up. But look, it's just, call it what it is. The royalty model and the provision of royalty capital to the broader mining sector is not fringe anymore. This is not like sort of out there on the edge. This is mainstream. It's really hard right now, I think, to find a major project, including some of the ones being advanced by the majors, that don't have some component of royalty and stream capital embedded into the capital structure, generally to the extent that, the project can support, because it's just really well aligned capital. It'll be interesting as we go forward here, with obviously there being more other forms of capital suddenly with eyes on the sector again, and how competitive that capital comes, how that comes in and how it competes with royalty type funding. But again, you can't take it away at this point that royalties are a really important. Royalty and streaming financing, I guess, is just a really, really important part of what makes the whole mining world tick these days.
Absolutely. Let's go further with that topic. If we look back, I think the deal that stuck out to me a couple of years ago was when G Mining financed Tokenzinho, and they had a blend of that sale of the royalty to Franco-Nevada. They had some debt and they had some equity, which is sort of like the prototypical blend. The percentage is definitely varying. In terms of cost of capital, given what we're seeing, the interest rates coming back, can royalty companies still offer a better cost of capital than the banks?
A different form of capital. I really don't think that it's a one-to-one comparison. If things go wrong with your project and there's delays or any kinds of hiccups, the bank's still going to come knocking once that maturity looms. Whereas with a royalty company, you've got a partner, right? You as a royalty holder, you've got to ride those ups and downs, and hopefully in the long haul there's more ups than downs. But the royalty company isn't going to come and foreclose on your asset when any one of the million different challenges that a mining project can face suddenly presents themselves. And that's the big difference here. It's more like equity in many ways, but I guess with costing, that's probably somewhere in the middle between the two types of capital. But you truly are a partner. You're not liquid in that investment. You're just there, and you better have made a good technical call. You better have made a good management call, and be happy with your partner and your project, because it's your project at that point too. And that's what's different.
Let's talk about new entrants. And I think Tether's, aggressive entry into the royalty space and accumulation on the gold side of things, has been a really interesting thing to watch. Do you view it as validation? Outside money or non-traditional capital source entering, or do you view it as a distortion risk where, really they're throwing off valuations and it's really distorting the market?
I don't necessarily think it's distorted the market at this point. Obviously it'll be a function of how much these non-traditional forms of capital want to come in and play, and whether it's only through investing in existing established royalty and streaming houses, or if that spreads into more non-traditional houses trying to write their own royalties and structures, which is probably likely. It's a hard model not to get enamored with once you discover it. Let's face it.
Totally. And like, especially with Tether coming in on the precious metal side, I listened to a couple presentations from the Tether CEO. I forget his name, but he was talking about not only their aggressive approach to equity acquisition within the space, but also on the commodity side, buying gold on a weekly basis, with this sort of long-term view of where they think they need to be positioned with gold. And so, like, I think, this is part of those, I sort of see it personally as a disruption, where, the central banks, and I guess to a certain extent, the general public or general retail were big buyers. But then you have these guys that are from a totally different world, that tech side of things, that have valuations and cash flows that definitely outnumber the stuff that we've seen in the resource space, and on the valuation side especially, really skew things for an investor that has been in the space for a while, and then you have this huge amount of money kind of flow in. It's definitely different.
Yeah, it's different. I mean, I don't have my head wrapped around it. I'll be honest. I don't personally own any crypto type currencies or anything else, but I suppose another question though is the money that's flowing into Tether, which is then in turn being put into these commodities and these equities, is that money that would otherwise have come in some other way? Maybe not. Maybe they're actually creating market and expanding just the overall available pool of capital and putting things together in a way that gives it more staying power, or not. We'll find out, I guess. But it's also kind of interesting because, for most of the past, say, 5 or 6 years, if you're involved in our business, if you're a gold company, you would have seen the crypto world as a competitor, right? It's sucking money away from gold as a, traditional safe haven. And, over you go to here, and now you're seeing it all. Everything's just sort of getting tossed up in the air, and I guess we'll find out where everything falls, right?
Right. Well, do you think with it's seemingly the focus is always on the precious metal side? And I shouldn't say always, because the advent of the sort of green revolution, net zero, these sorts of narratives have definitely shifted, the investors' thought pattern towards energy metals, and the various things that go into battery consumption and such. With the focus on gold, are these companies or these outside sources missing out on the base metal side and the energy metal side?
That's a really tough one. I guess I'm just not close enough to what that type of money is doing. I can just speak from our own perspective, particularly on the U.S. side. This is not new. This is cyclical stuff, but we are starting to see, good flows, capital flows into our space from, sort of large institutional pools of money, particularly in the US, strangely quiet coming out of Canada. Like the non-existence of the pension money, for example, in the Canadian mining industry is pretty incredible, quite frankly. I guess if we called it private equity, maybe they'd want to play or something. We just got to repackage it. But so there's look, a lot's changing, but nothing is changing. This is all the same movie over and over. And money has decided that capital has decided that structurally, fundamentally, this is the time, and it's starting to pile in. We've certainly seen it. We've like our institutional ownership, particularly stateside, has gone up pretty dramatically in the past year.
We were talking about royalties. There's definitely competition within the royalty companies out there for each deal. Specifically, when we talk, you have using yourself and Origin as an example. You both went different routes in terms of who the ultimate buyer was, or the sale was, of that royalty. And I wondered what, from your perspective, when you're selling those things, what differentiates who you're selling it to? Is it just about price when it comes to the sale of a royalty?
No. I mean, I guess more generally, it's going to come down to that. If you're a seller, you're a seller. You're going to want to get the best price. But we went into the process probably a little different than Origin did because we were quite open about the idea of swapping some of the gold royalty exposure, which was kind of getting almost out of weight in our structure for non-precious metal royalty exposure, because a lot of the precious metal companies do have some typically ancillary type non-precious metal royalty exposure as well. So we're willing to do that kind of balance. It's not how it played out. And to be, I mean, we were a major shareholder of Origin as well, so our marketing kind of timed together, and there was no collusion, but definitely coordination around, just putting technical heads together and really trying to get our heads around what the optionality and upside proposition that the Silicon royalty represented at that time, and how best to be able to present that to the potential market. And I think we each had quite a bit of fun with that because we got to be geologists for a while, right? We're out talking about drill holes and how big resources were going to become, and it was a lot of fun. But I think that Origin went first, and obviously ended up transacting with Triple Flag, and the piece that they bought from Origin was a good sized piece for Triple Flag. So I mean, they in some ways took someone out of the market, but on the other hand, it also put a marker out there for the rest that hadn't been successful in the Origin piece. And at the same time, good news continued to flow from the asset. And but I think Origin did a really good job. I think it worked out really well for us. I think it's going to work out really, really well for Triple Flag, and it's going to work out really, really well for Franco. In hindsight, would we have waited for the extra $1,000 on the gold price? Probably, but it's not how the game goes, right? There was more to it than that as well for us. The interest, it was very competitive, and the interest did involve some potential asset swap type transactions. So that had to get weighed in. There was, in a couple of instances, there was even corporate level interest in Altius. I think there were some groups that felt that rather than compete just at the asset level, that they'd be willing to go for the full corporate part there. And so it was a lot of work. I mean, it took us a lot to really try to get our heads around what is the right thing to do here for our shareholders and what represents the best long-term value. And again, I'm just really happy that with the way it worked out, I think the decision to hold on to a piece that's still really, really meaningful for a company of our size was the right move. And that's irrespective of what you might think about the gold price. That's just a call on the asset and the geology. This is a special one, and it's more likely to give positive surprises going forward than negative. And never easy decisions. I mean, and it's not in our nature as royalty companies ever, I don't think, to be sellers. So we're just accumulators typically, right? So one of the trickier decisions I would say we've had to deal with in the past 28 years or whatever it is. But when the cost base is what it was and what's on offer is what it is, it's used a cliche, but world-class problems.
Well, when it comes to consolidation of the sector in general, when you look at that going further, obviously, I think for companies like Franco, Wheaton, especially at the very yourselves at the very high end, how do you think consolidation gets put forth? Like, what drives it? Is it specific assets, something like a silicon that's very special that could be multi-decades on the precious metal side, which is very unusual? Is that what drives consolidation? Or again, is it just overall NAV? Like, what stands out in royalty companies as reasons to bring companies together?
I mean, I guess there's a couple of ways to look at it. One is what would have done it in the past. And in some cases, that's been, just relative valuation. There's certainly been premiums that have been assigned to scale and liquidity, and that's been something that some have been able to take advantage of. Particular views around, particular assets and just how that asset mix evolves, how you shape your portfolio, everything from commodity to country to, stream versus royalty mix. So there's all those kinds of things I think that come in play. I can't imagine that relative valuation isn't going to dominate in that though. And I suppose going forward, it gets interesting from here in that, particularly on the commodity side of things, that divide that's been there, or at least recognized as being there forever between precious and non-precious. And this is kind of double-edged for us, but it's getting blurrier, right? There's a lot more participation in the non-precious space from the precious metals companies as they've taken on scale as we go forward. And the negative of that is that we're obviously now got pretty formidable competitors in where we wouldn't have otherwise. But on the other hand, does that blurring also lead to less of a spread in relative valuation just on the basis of commodity, right? I mean, to what extent does the market let someone use a precious metals multiple to become a purchaser of non-precious metal assets before they recognize, well, we should just buy the non-precious because we'll get the precious metal multiple the other way, right? So that's I think some of that's happening as well, and we hear that a lot from institutional investors lately, and I've been talking about it for years. There's no good reason for a premium for precious metals cash flow streams over base metal ones. In fact, there's great reasons for the opposite to be true. And, it fell on largely on deaf ears. And now people are coming to me with that idea, and testing it out and saying, well, what do you think? Why is that? It shouldn't be, should it really? And it's like, boy, I could, let me pull up some decks from about 20 years ago for you. We'll go through. I gave up on that argument a long time ago. But yeah, it seems that I know in some of the people that have been accumulating positions in Altius, that's been part of the thesis. So that's kind of neat. So who knows what will drive M&A in the future in our space, but, and the drivers probably are shifting, particularly as it comes to relative valuation.
How about network? I think, one of the things I've noticed, as you said, like as things get consolidated at the top, there seems to be these new little royalty companies that pop up out of nowhere. And I think the trend, at least that I've seen, is that these are, they're people that are definitely connected to the right people because they're able to grab these packages. They're spinouts from majors. They have this royalty package or development package that is no use to them given where they're headed. And so they spin it out into these juniors. So I wondered, especially when you compare, you guys have concentrated on project generation. But how do you weigh the opportunities versus, project generation, which is very organic, and you have a great team that you can do these generation projects on the cheap, versus going out there and looking and seeing how you can compete with these, I guess, I don't know who knows about these royalty packages that are kind of buried in these senior companies, but there seems to be something there in terms of how that network is important. And I wondered if that connects to, who you do deals with in the future, whether it's on big M&A or even on the smaller side.
Yeah. And, to be honest with you, that works from both sides right now. From what I can see, it's not just who is wanting to start a royalty company and who knows who that they might be able to call up and say, hey, can you, dig through the files and show me what royalties you've forgotten that you have? Because there's not much of that around anymore. But what is happening is that, like if there's a real trend, you're starting to see from juniors and even seniors alike, people are actually writing their own royalties on their own assets to spin out. And in some cases, it seems like with target management groups in mind, right? There's just that, I can write a 2% royalty on this particular asset, and that 2% is worth the equivalent of 10% equity once it's in a royalty structure. And, I can harvest that capital and put it towards project development, or again, just another piece of confirmation about how vital and how mature the royalty construct is within the overall mining space. When you've now got big guys with 100% equity in a project choosing to write royalties on them, not necessarily to raise capital or to, as part of a capital stack for project financing or anything else. But at early stages, we've got this project. Well, we're going to keep most of it as a project interest, but we're going to carve out this royalty and park it over here. So there's forethought going into the building of these portfolios right now.
How about if you could take your perspective as an investor that's looking at the lower end of the royalty company stream, like these new companies where, there isn't really a differential between revenue, like most of them have little to nothing. If you were an investor looking at that end of the market, how would you differentiate between which one to put your money into?
Well, it'd be technical first. I just want people who know what makes a mine and what doesn't, because in the end, these royalties aren't worth anything if the mines don't get built, right? They're just pieces of paper that you spent a bunch of legal fees on creation, so they're actually cost centers. So it's got to be a good technical, good set of technical eyes, but thoughtfulness as well in how things are being structured. Like serious players, you want to see serious players, not just people who want to be able to say the word royalty because it's hot in that moment. It's really not rocket science, but you can blow up a lot of money. You can make a lot of mistakes by picking wrong or pricing wrong. And I suppose the other part of this is not just having those abilities, but having those abilities get recognized ultimately by financiers, because depending on the stage you're selecting for, you're not buying these at initially implied 30-40% IRRs and you can afford 15 or 20% money to make the deals work. It's tighter than that, right? So you need to be able to match good project selection and structuring with the ability to attract capital at a reasonable price relative to the opportunity. Right. Again, no rocket science here.
If you had to look or say where the contrarian opportunity is in the market right now, where would you say it is?
Well, I would say that the deal we announced before Christmas, would have fit that bill. There's other parts of the market. Like I've always believed that once these bull markets get going, even though all these commodities tend to have their own setups and fundamentals and everything else, but once it gets rolling, it's like a wave that sweeps over everything eventually. It's not perfectly timed, it's not perfectly even, but it's it happens, and it's usually led out by gold. So nothing seems out of rhythm to me in this one over other ones. You look at the headlines and see what people are not excited about. So even lithium from 3 months ago to now, maybe that drumbeat is shifting a little bit. I don't know, take your pick. What are you not hearing about? That's where you should be looking, right?
Right.
Yeah. Well, if you're hearing about it, everyone wants to knock it on its ass. So like something like iron ore or something like that, right?
Iron ore, oil and gas, like especially in Canada. Those are the opportunities.
Once this gets rolling, it washes over everything. Because I think it's a function as much as anything of, well, it is a function of the capital investment cycle, and there is a herd mentality to this. If you've got a long period where they're having big inflows of capital into replenishing depleting assets, well, it's eventually going to come home to roost, right? But the other factor is sentiment, and so we get a gold market running now for good stretch. People have made lots of money. Maybe they're expressing something you expressed right at the beginning of our conversation today, is like there's reason to be nervous as well because something has run a long way. So people start to say, well, what's not, what hasn't come along? I love this mining business. I'm making lots of money in it. Where do I go now? Where do I park some of those profits? And so that's how it it kind of cascades, at least in my experience. So it's all, there's nothing feels very different. It's just as wonderful as ever, including in the bad parts, by the way. You've heard me say that. I like the bad parts as well, too. Sometimes more.
You've definitely demonstrated over the course of Altius's history a definite ability to be patient and be contrarian with the market and have that long-term horizon. And I would say, having spoken to you for a number of years now, it seems to be innate to you. But I wanted to ask you, do you think patience is something that you're born with or not? Or can someone learn to be patient and sort of I think contrarian and patience is sort of different, but you're definitely a better contrarian investor if you have patience.
Well, it comes down to what you are, I suppose. It's not whether you're patient or not patient. It's whether or not you're an investor or a player or a trader, right? That's probably really what it boils down to. Because look, these investment cycles are long. We all know what the timelines are from discovery to production, and even from once you're incentivized, how long it takes for these things to play out. In a lot of cases, the timing is really tight, and you can get it right. You can do it at the right part of the cycle, but if everyone else does it and you all come to market on the same day, well, look out, you're going to have a few rough years. But that's opportunity as well. So it's just a hard question for me to answer. I mean, I go back, it might have been clearer back, say, when we sold, we made all that money in the last market cycle, and we're talking about we're going to become a non-precious royalty company and and this is what we're going to do. And then we sat for 5 years because we just couldn't stomach the prices that were on offer, right? And it was just a function of the fact that all the other forms of capital were so readily available and cheap that anyone we tried to transact with had a better option than we were willing to come with. But they eventually all left, and one crisis or another would have set in, and you wait for your spots. It's just so basic to me that maybe it's experience, but how the very same asset, with no real material changes to speak of around how it operates or the geopolitical backdrop around it, how it's the same asset can be so the valuation for it can be so radically different over from tops to bottoms, right? It's the same asset, right? And there's a mid price through all of that. And if you look back with hindsight, it gets easy to wipe out those big ups and downs, but it's just the way it is. Like, that is what it is. And you would think that the market would average all of that out because it is the way it is, but it doesn't. And that's wonderful, right? So it does. You kind of know it when you're paying a price that at a point in time that probably means you're going to have a good chunk of the front years of your investment, those critical payback years, at lower prices than you're assuming right now. You might be fine in your long-term assumption, but there's a big difference between, having a mid-cycle price embedded into your purchase structure, but then getting better than that for your payback period, than getting worse than that for your payback period. Like, it really changes the game. And it's, in some ways, being a royalty investor you really don't have a choice, right? Because it's not like you can just trade in and out of it if you feel like you got it wrong. Like, you're in it and you buy it, you're in there, right? So you really do have to be a bit more thoughtful about, well, I can be wrong on this, so I'll just pull out and I'll come back in when it's right if I get it wrong right now. Well, it's not like that. You're in. When you're in, right? And if you're in, well, you might as well be in for 30 years if you're going to be in. It's better to be in for 30 than 10, because even if you've got some of it wrong, that's a lot more time for things to sort themselves out, right? It's a lot more cycles. It's a lot longer for inflation to work in your favor as a royalty player. And yeah.
Is being a good investor the equivalent to being a good business grower, or orienting a business towards growth, or being a good businessman? Is that one and the same?
I guess the business part would look to more towards just like, how do you want your portfolio to shape up? Durations, optionality, asset selection. Like, that's kind of just fundamental basic stuff. The investor part of it is kind of what I talked about in terms of, are you buying at, it's valued here at this part of the market, it's valued here at this part of the market. And that can be an order of magnitude, like not 20% either way. It's an order of magnitude. And the difference between being that buyer here versus here, that's the investor part, I guess, right? Yeah. And you won't get it right all the time, but you should have a good grounding in if something feels too good to be true, it probably is. And if something feels really stupid, like that doesn't make sense for this asset that's produced that much cash flow or that will produce that much cash flow with conservative assumptions to be priced like this. So I know it's hard. It's hard. Sometimes there's a lot of emotions to fight, and yeah, it's hard being a down cycle investor, and it's never easy. You never know, but your gut tells you something. As long as it feels a lot harder to do it when it feels euphoric, then you should be okay. Yeah. When you hear it's different this time and it's going to go forever, then you should probably, yeah, that might be a good time to start buying your AI stocks then.
Yeah, good point. Let's talk about your deal. So in December or mid-December, you announced around a $520 million acquisition of Lithium Royalty Corp. Big deal, massive exposure to the lithium market. Why lithium? Why now?
Well, we've been involved with Lithium and Lithium Royalty Corporation actually for quite a number of years. So our first investment, I think, would have been 2017 or 2018. And it was at a point in time when we were thinking about, going in more directly ourselves and starting to look at building up our own direct portfolio. And that's when we, were in conversations with the group that were putting LRC together and really just came to the decision that they were bringing something to the table. They had a head start in terms of the contacts and leads in the space because it's an interesting ecosystem, right? The players in lithium, at least at this point, are a bit different than the more traditional mining players. Like there was a different grouping of different cast of characters there, and they certainly had that. That was through Ernie Ortiz and plus the guys at Waratah, co-founders, had a lot of conviction and were making big equity bets. So they were building up a lot of rapport with the project sponsors just because they were, one of the few players in the market that was writing equity checks. And so it just made a lot of sense. And we felt like we could bring something to the table as well in terms of the hardcore technical work in evaluating assets, certainly in royalty structuring. And the other factor for us at the time was that it was just so tiny. The market was smaller than we would typically like to get ourselves involved with. I mean, up to that point, we would have played in some of these other smaller markets as we were cutting our teeth and probably would have generally had our heads handed to us when we did. And, kind of we're at that stage where there's a minimum market size that you really want to be attaching yourself to for safety and comfort. And lithium definitely wasn't there. But it did have that feel about it that it could get there, right? So it was the right way to dip our toes in, and we worked really well together with the guys. And I think the asset selection was really good in that it was done skeptically, right? It rejected a lot of the stuff that was hot at various parts of when lithium was kind of roaring and hot, and was pretty fundamental and was based upon things that we thought should get built in a rational market, as long as that demand growth side of the equation and overall market size of the equation test was going to get met. And so it's really in the past year or so that, partly as we were monetizing around the Silicon asset, certainly as it was starting to feel like we weren't going to be pulling off a deal that brought in a whole batch of assets back to Altius in the non-precious space, that we took that other hard dive. And it's pretty remarkable how quickly that market has been growing and compounding. And I know there's lots of noise out there, and there's someone saying, oh, well, EVs are not living up to the hype and all this sort of stuff. Well, I'm sorry if it missed your expectations and it's only been compounding at 25% a year instead of the 29 you were expecting. But when you start getting up into the scale that you're at right now and just keep compounding at those numbers, let me tell you what's happening. You've got a market developing, right? So, that test got met for us, and obviously the market cycle was doing its thing. There's no question, the lithium price got ahead of itself because it ended up being oversupplied, right? Classic definition of an incentivized market is one that will bring supply, and supply it brought, and it brought too much. But again, that same compounding demand growth, things catch up. Things can catch up pretty quick, and that's what we started to see was happening. The other thing I'd say is, if you'd read any of the reports from the analysts a year and a half ago, they would have said that this oversupply in lithium was 3 years, 4 years, 5 years out before, demand would catch up to balance things out again. And it was an interesting perspective, but through our investments in electricity generation in the US through Altius renewable royalties, we just started to see that every single project that we were attached to or trying to be attached to felt suddenly anyway, like there was nothing being brought forward anymore that didn't have a gigantic battery attached to it. It's like, wow, okay. So now all of a sudden in the past 4 or 5 months, there's, all these new revised reports coming out, and it's like, oh shit, this market's going to balance a lot faster than we thought. And the reason in every case is because we missed this huge demand push that was coming in from the electricity side, from the storage side. That's what's caught everybody out. And now all of a sudden it looks like we may already be, back to a balanced market. So that's kind of where the narrative is right now. So I'd say we probably got this done, got the silicon deal done and then moved on to this kind of, as late as you'd want to leave it and still say you were doing something that was reasonably contrarian, right? But it's still not a mega scale market. It's still very volatile. But I'm comfortable enough that the scale of the lithium market has reached that point that it's investable for us. I'm really happy with the assets that sit here. And this is where it gets interesting now. The long life assets that are in LRC that are in production. And this would span, big brine projects as well as hard rock projects. They underpin the investment. Like they really do for us when we put, what we consider to be a reasonable long-term price. So that kind of underwrites the base investment for us. But if we've gone into a deficit situation, the response to that is going to be incentivization pricing. And that's fun and that's neat. And it probably means if we've got it right, that we'll get paid at a higher lithium price in the early years of our investment than we underwrote, right? And that's good for our shareholders, and that adds an extra layer of comfort and security. But that's not enough either. Like that's not the speculation that we're trying to achieve here. It's actually what happens from a volume perspective as we go forward that underpins this investment. So yes, it's all predicated on a market that needs more supply to come on stream. It's predicated on the market giving pricing that incentivizes that supply to come on. But then the most important part kicks in is where does it come from? What assets are the ones that get selected for investment? Which are the ones that fill that next leg of supply? And so that's where a lot of our conviction on this investment comes in from. Like we believe that LRC has done a great job of adding assets that are going to attract an outsized share of that investment in this supply, capital cycle, relative to the average. And I also believe that this cycle will be more discriminating than the last. The last literally turned into a frenzy, and if you could spell lithium, you were going to get funded. But and this is natural. This time, I think the asset selection is going to be more thoughtful. The geopolitical backdrop is certainly more thoughtful. And, there's some things there's going to be some distortions in it just because I think some projects will get built that shouldn't because there's a geopolitical imperative to do them. So it's not just pure capitalism deciding which project is better than the other one. So that's a little trickier to navigate, but the bottom line is that, yes, I do think that this is a market that needs more supply to come on stream. There will be better prices. In fact, even since we've announced the acquisition, that started to be borne out. But again, most important of all, in the fullness of time, we just have a good feeling or good conviction, maybe is a better way to put it, that the total volume of production that comes from this portfolio, incentivized during this cycle and the one after that, we'll make this a good investment for us in the long haul. Meaning 20, 30 years, out. These will still be. There's a lot of really long life assets in here. So I mean that's the first critical box that you've got to tick if you want to catch our interest.
It's expanding on the geopolitical side, because one of the first things that popped in my head when you were talking, at least, and this is what I want your opinion on, is, there's a narrative that talks about security of supply, and we live in what looks like going to be a more fragmented world. So do you buy into the narrative of security of supply and how that might affect, and it doesn't even have to be just lithium, but the resource sector, period?
I mean, your question is way broader, obviously, because what you're really going to here is there, deglobalization? Are we in a period of deglobalization right now? And that's a much bigger question than, the mining industry. That impacts a lot more than the mining industry. There's pretty good arguments for it. I mean, we're seeing it, say, in potash, where it used to be not that long ago, where potash found its way to the closest farms that needed it, and that's what made the most sense. And the least amount of capital got burned up in unnecessary logistics. Well, that's out the window for the time being. Maybe it shifts back. Yeah, and again, it's concentration of supply. It's not all good. Maybe it had gotten too far the other way as well, if these are truly critical and you're dependent on them. But yeah, it will cause distortions. Like there will be, if this was as simple as just saying, what are the best 20 projects that supply the market? So we'll pick those and we'll invest in those. Well, 5 are not going to make it because 5 dogs that shouldn't have got built just because of where they are. Right? I mean, that's just the reality of what it is. I guess you can go really broad with what the can of worms you just opened up there. And it really brings home to, I really think about this a lot, but lithium, copper, direct royalties on electricity. Because somebody said to me, are you over concentrated now on lithium? And I said, well, I wouldn't say that, but we probably are really, really, really linked and, and concentrated on the growth of electricity demand overall, because that's the theme that ties all this together, right? That's where it gets interesting. I mean, what's interesting about electricity is that it is a local market always, unless we're going to start dropping subsea cables from Newfoundland to Ireland in the next period of time, which would be really bullish for copper if we do, by the way. But you know what I mean? It's like, I wish I knew the answer to that, because it's a really big crystal ball question. But just expect more distortion, I think, for the time being. I suspect that there's a zenith of this sort of deglobalization that's looming somewhere, and there will be an element of reglobalization somewhere in the future from here. This stuff is never a one-way street. Maybe we've become too globalized, and that's why things are deglobalizing, and we'll probably pendulum swing to too much deglobalization to have things rebalance again. There's a reason these things happen, and it's, globalization didn't benefit everyone equally, and so there was going to be pushback from some quarters, and that was going to build right-wing politics. Will go too far, and you'll get a push that's too far to the left, and vice versa. I mean, these pendulums will swing. It's not good stuff to try to. It's not good stuff for your brain to try to build long-term investment strategies around. I think you just got to trust that some logic will prevail in the end.
Right. Just going back to the deal, there's the option for Lithium Royalty Corp shareholders to kind of wade between cash and shares in Altius, and Altius' share price has been fantastic. Maybe you would say that the push might be towards going with the Altius shares instead of the cash option. Do you worry about dilution, or is it obviously the cost of capital and what that investment means is, I guess, at the basis of it? So dilution isn't necessarily a concern in this case.
That's the part I least like about the deal we've put together, I'll be really honest. But the reality was, I think the major shareholders of Lithium Royalty Corporation weren't sellers per se here, right? It was the idea of putting all of this together to having the continued upside exposure to lithium, but, maybe watering it down a little bit, which you will, with something that's, equally exciting in the upside that's coming in from copper and long-term. And like, it was that combination that was attractive. If it was an all cash offer, there was no deal on the table. That much was clear to me, right? So that was a hard part of this for me. I have an old mentor who used to take me around in Europe. His name's Tony Mahalski, and he'd give these wonderful flowery introductions whenever he went into a meeting, and he'd talk about every share is a prisoner with these guys and all that. So it's beat into me. But in this case, the long-term value coming back means it's not really dilution, right? So there has to be, it's only dilution if you're not getting back more on the numerator than you're losing on the denominator. And it made that test. And don't forget, these cycles keep doing their thing, and they always will do their thing, and we might get all those shares back someday. You never know.
Right.
In fact, we probably will.
In prior conversations, we've gone through sort of binary choice with metals. And I think considering where we are in the market, this sort of bull phase, I would say that, you're probably bullish on a good portion of the sector. So instead, this time, I was wondering if you could just rank the opportunity. If you took the precious metals, gold and silver, nickel, copper, maybe you want to throw lithium in there too, for the conversation's sake of what we just talked about. Where do you see the best opportunity over the next 3 to 5 years?
I guess I'll preface that a little bit. So copper has kind of always been, whenever we get questioned on cyclicity, it's kind of where we always point to. It's hard to make the argument that copper right now isn't pushing up against what we would call our incentive price, right? We've got to be consistent. We can't move our goalpost just because the price has gone to where it is. But I will say this. So let's say, for argument's sake, that the incentivization price for copper is $6 and the current price is $6. That should give pause, right? That should say that, you've missed your window. There's two arguments against that. And this is not to say, like, don't read too much into. I'm using copper as an example just because the numbers are on the top of my head, but like it should be looked at more broadly. There's two interesting things going on. It's something I said earlier. There's mid-cycle on the way up and there's mid-cycle on the way down. One is constructive and the other is going to ensure a very low return on your investment. So because it's the overshoot factor. Money doesn't flow when you hit the incentive price. Money flows when you get to twice the incentive price. So basically that's me saying that there's $12 copper in this market somewhere. And by that time, look out, there will be lots of copper projects getting sanctioned. But again, I got to be careful here, just because every other time you would have asked me that question, I still have piles of money left to deploy. So I don't want to shoot myself in the foot too much. But the other thing about that copper price, I just want to finish it on, is that we're getting to that point now, and it hasn't even begun yet. That $6 incentive price, that's today. I don't know what that incentive price is going to be in 2 years from now, but I have a funny feeling it's going to keep ratcheting up from here. Like that price, that incentive price, the price, they've touched each other before and then they've spread. Sometimes they spread with the price going off the incentive price and then you get the party going. Other times it goes the other way. We're getting the prices now, I suspect, where you're going to start to see a lot of like hands out from government for an extra take. You're going to get a lot of labor disruption about to start because unions have finally got some clout to work with. And all these things are going to, kind of come home to roost. A bunch of people are going to start to go at the same time looking for engineering support and equipment and all that. That's going to strain an already decimated sort of, supply chain. That's going to have big inflation. Like there's another big leg up in the I suspect there's a big leg up in the incentive price calculation to come. That's a function of the first leg having been met, right? You can go back to 2003, 2004, and you would have calculated a copper incentive price at $1.20 or something. But by 2007, 2008, that had gone over $2. Right. So that's the other factor. You can't just assume now we're $6 incentive going forward. Yeah, there is a point where the price will exceed it, but don't forget that the incentive price moves too. That's the other thing to be careful of here. So I'm not going to answer your question any more specific than that, but that within all the commodities these are the things we've got to keep an eye on and watch for. But more than anything, it's still about asset selection, optionality. It probably means for us going forward, more work being done on more development stage, or if not operating with, sort of narratives there around potential big brownfields expansions, those kinds of things. Like for us to get really constructive going forward here, we're going to need to be able to put our technical chops to work a bit. Like it's not just the market, just the cycle doesn't do all the work for you anymore now. You've got to actually, get really technically stuck in there and make some bold calls. But that's fun too.
Absolutely. In terms of Altius in the market, if people want to visit or connect with you guys, I assume that you guys are going to be at the VRIC again this year, like in the past.
Yep.
PDAC and then Rick's event in Boca in the summer.
Yep.
Excellent.
That's the plan.
Excellent.
That's the last floor it took me through, but there's a few more bank run conferences and things like that you can find us at. And
excellent.
And anyone who's ever reached out to Flora knows that we're very, very accessible. She's the best in the business, and I'm always happy to jump on a call with anyone as well.
Excellent. Brian, thank you so much for your time, insight. We definitely have to do this again soon.
Sounds good. I enjoyed it.